Hello, Luke Stein here. This video is going to introduce the quantification and analysis of returns and risks on stock investments. We've already talked about how to think about returns and risk on bonds. For bond investments or debt more generally, because promised cash flows are specified contractually, we know what they are, and it's easy to use them to calculate the rate of return that investors expect to return on a debt investment. For a bond, this will typically be the bond's yield to maturity. On a loan, this would typically be the interest rate on the loan. For equity, things are more complicated. It's harder to calculate equity or stocks' expected returns because the future cash flows are uncertain. Because we don't know what cash flows investors necessarily expect, it's hard for us to use them in order to figure out what rate of return is consistent with the price at which a stock is currently trading, as we did with debt. Therefore, we're going to need a model in order to estimate the amount of risk involved in an equity investment and a way of thinking about the extra rate of return that investors require per unit of risk that they take on. And the main model that we're going to use to do that is one called the Capital Asset Pricing Model, or CAPM. This is a Nobel Prize-winning idea developed by a set of scholars in the 1960s and 1970s, although of course it has intellectual roots that go back further than that. And the CAPM, as we'll see, is going to allow us to try to estimate equity investors' required rate of return as a risk-free rate, as always, plus some risk premium, but where the risk premium is going to be determined by the quantity and the price of risk measured particular ways. Our quantity of risk measure is going to be called beta, CAPM beta, and the price of risk, or the amount of additional return that investors require as compensation per unit of risk, is going to be measured by something called the market risk premium. But before we can get to thinking about how to quantify risk and therefore price it, we need to be able to talk about the rate of return that an investor earns on an equity investment. The CAPM model is going to be widely used, but it's only one of the models that managers use in order to think about determining required rates of return on equity investments. And managers responding to a survey have described CAPM as perhaps the most popular, but there are a variety of other methods that they use. We're going to focus just on the CAPM, or capital asset pricing method. So let's start by thinking about what the return on an equity investment looks like. It's going to be relatively easy for us to measure historical returns. So figuring out for a given equity investment for a given period of time, what rate of return the investor earned. It's going to be a little bit harder for us to think about how to quantify risks because this is going to involve thinking about distributions of returns, and there's a variety of ways that we can summarize the amount of risk or uncertainty in a statistical distribution. Some of these are going to involve basic measures that you may have been exposed to before, like standard deviation or variance. Some of them are going to be a little bit more nuanced and involve assessment of the co-movement, or the degree to which different assets tend to move in the same direction at the same time. Of course, doing this is relatively easy as long as we're working at historical data. We can take information about what's already happened, the dividends that a stock has paid, the price fluctuations that investors have endured, and we can use those in order to think about returns and risk. Doing this in the future is really, really hard. So let's start with the easiest possible case laid out on the slide, which is going to be an assessment of historical returns. How can we think about, for a given period of time, the rate of return that an investor has earned on that stock investment? And here's the math that we're going to use to do that. If it looks complicated, don't worry, an example should hopefully straighten things out. We're going to quantify the rate of return earned on any equity investment by, in the numerator, calculating the cash flows that investors receive by the end of the period. And there's going to be two. So an investor who buys a stock may receive a dividend, and she has the ability to sell that stock in the future. So if we add next period's dividend with the price that she's able to sell it for, that gives us the total amount of cash that she should expect to receive if she invests in this stock. Then we have to subtract off the amount that she paid for the investment. So that would be the price at the beginning of the period. Then we divide that by the amount that she invested in the equity, PT, the price she would have paid at the beginning of the period. In the numerator, we have the amount of gain that she earned. In the denominator, we have the amount that she spent, and that therefore gives us her rate of return, which we'll call RT plus 1. So one way to think about breaking up the numerator is that the first two terms represent cash in, and the second term represents cash out that she had to pay. There's another way that we can break up the same sum, which is we can combine the first term or have the first term stand alone, and that's the dividend that the investor earned. So we see that over here. And then the second set of terms, PT plus 1 minus PT, tells us the amount that the price of that equity investment went up over the period that we're analyzing. And we call that amount the capital gain on the investment. So we can break up using that second breakdown the rate of return that an investor earns on any investment into one piece that we call that investment's dividend yield and a second piece that we call the capital gain yield. How much of her return is coming from the fact that she receives cash in the form of a dividend, and how much is coming in the form of the fact that the value of that investment appreciates whether she sells the stock or not. So we're going to call this a capital gain yield, whether that capital gain gets realized through a sale or whether it doesn't get realized and it just shows up as a gain on paper in terms of the value of her investment portfolio increasing. So let's try an example. Suppose that Microsoft paid a dividend in mid-November of $3.08 per share after you had bought Microsoft at the beginning of the month for $28.08, and immediately after the dividend was paid, you sold it for $27.39. Suppose we wanted to understand what rate of return you earned on that holding period. So over that holding period. So the first thing we need to do, and we're going to try to answer not only the question that's in the box, but also break it down into the two components described on the last slide, is we can think about what the dividend that the investor earned was, and we can think about the capital gain that she earned on her investment, the appreciation or increase in the value of the actual portfolio above and beyond the cash delivered. So the dividend is given immediately in the question as $3.08 while she held the stock. What's the capital gain going to be? Well, it's going to be the difference between the price that she sold for, and in this case she did sell, but it could just be the price that she could have sold for. That's the $27.39 that she could sell for at the end, and then we have to subtract off the $28.08 that she paid at the beginning. So this math shouldn't be that hard to do, but let's go do it in Excel, especially since we're going to have to do some division with it in a moment. So if we move to Excel, we can note that at the beginning, the stock had a price of $28.08. At the end, it had a price of $27.39, and that means that the change, which is going to represent her capital gain, is obviously going to be negative, and it's going to be negative 69 cents in this case. Then, if we think about what the dividend that she received was, the dividend that she's going to receive over the course of the period was $3.08. And let's just put that there because she started with no dividends and she ended the period having received $3.08 worth of dividends. And so her total cash return over the course of the period is going to be the sum of those two, or $2.39. So she's going to receive $2.39 in cash over the course of the investment. That's her cash return. And conceptually, we could, of course, break that down the way that we did, which is that was a 69-cent capital loss and a positive $3.08 dividend. But if we'd prefer, another way that we could think about this is that at the end of the period, she has the $3.08 dividend. She began the period with no dividends. And now we could instead describe this as her having started the period with $28.08 worth of Microsoft stock, ended the period with $30.47, of which $27.39 was in her portfolio and $3.08 was in cash. And the difference between those two, of course, is going to be the same $2.39. So those are just the two breakdowns that we saw on the previous slide. One where we can see this as a change in the total value of the portfolio, end minus beginning, and one where we break it down into the change in price versus the change in dividends. So having calculated the capital gain or price change and the dividend, we can express those as rates of return just by dividing each one by her initial investment, and having lost 69 cents on $28.08 stock, she has earned a loss. Let's show that as a percentage of approximately 2.46%. She has earned a $3.08 dividend on a $28.08 investment, or a 10.97% dividend yield, and her overall rate of return has been a $2.39 cash return on a $28.08 investment, or an 8.51% rate of return. Okay, so on the slide, we could note her total return of her total rate of return of 8.5% came from having earned about 2.5% having lost 2.5% in capital gains while having received 11% in dividends. Now, we're going to express that total return as if it doesn't matter whether the return came through dividends and capital gains. For some investments or for some investors, it may matter to them which form they receive their returns in particular, because there may be tax differences in the treatment of those two. We're going to ignore those at least for now. Okay, so here's a solution that just lays this out on the slide. If you're having trouble with my handwriting, as I sometimes do, and just tries to explain how this breakdown works. Okay, so we've calculated one return. We've taken a single month's return for Microsoft. And what we typically would do is we would calculate returns over a number of different periods, say a sequence of years or a sequence of months or a sequence of weeks, calculate a sequence of periodic historical returns for a given equity investment, and then use those periodic returns in order to calculate different distributional statistics to summarize what had happened in the past. And so we're going to talk right now about how we might do that by calculating average returns. And the easiest way to do that is a so-called arithmetic average. So if you've got 6 months, you could just add up each of the 6 months' monthly returns and then divide by 6. If you have 5 years, you could add up the 5 years' annual returns and divide by 5. And that's called an arithmetic average. That's kind of the standard way of doing averaging. There are reasons that you might want to do more complex averaging procedures, in particular, calculate a so-called geometric average, although I won't describe that today. If we wanted to understand something about the dispersion in the distribution, so we had, say, 5 years worth of annual returns, and we didn't just want to know what the average was, but we want to know how smooth that return was over the course of the 5-year time series, we could calculate standard deviations or variances as measures of the volatility of returns over the period. And a standard deviation we often abbreviate with the Greek letter lowercase sigma. A variance we often abbreviate with sigma squared. And you may not be surprised if you see us write it that way, that the standard deviation is indeed just the square root of the variance. So these are two different ways of writing the same information. If you know the standard deviation, you can always square it to get the variance. If you have the variance, you can always square root it to get the standard deviation. And as I mentioned earlier, there are more complex distributional measures that we may want to look at when we have more than one asset to consider that pick something up about the degree to which they co-move. So all of these are ways of summarizing historical risk or historical dispersion in returns for a given asset over different time periods. And they tell us about what's happened in the past. Of course, we are probably most interested in knowing what the risk is in a future investment in a given asset. And while the future is unknowable, we can often use the historical distribution of returns on a given asset in order to try to say something about what we think the probabilities of different levels of future returns are. So the past is not predictive of the future, but it may be informative. A short example on how we might do this. So suppose that we had 5 years of annual returns calculated as I just described in the Microsoft example. In this case, these are annual returns over 5 calendar years on the S&P 500, which is an index of the 500 largest firms trading in the United States. There's some additional requirements to be included in that index. So not only do you actually have to be one of the largest 500, but you have to have been profitable for a certain period of time, and there's some other restrictions. So an S&P 500 portfolio investment went up 4.9% in 2005. It went up or returned 15.8% in 2006, et cetera. So let's say we have 5 annual returns like this, and we wanted to think about summarizing those historical returns in order to say something about what the trend has been and also how large the fluctuations around that trend has been. So the first thing we could do, as described, is we could calculate an average. And in Excel, the simplest tool for doing this is a function called average. This is going to calculate an arithmetic average, which literally is as simple as just adding up these returns and dividing by 5, or in this case 5, however many of them there are. And so Excel calculates a 3.1% average return over the 5 years, where again, we could do this the same way just by adding up the 5 of them and then noting that there are 5, dividing by 5, or using something like the count function to count the 5 rather than my having to count them manually, and we should get the same 3.1% that we did using the average function. Of course, sometimes the S&P 500 did better than 3.1%. In fact, eyeballing the data, it looks like in 4 out of 5 years, it did better than 3.1% average, but in 1 year, it did way, way worse, which brought the average down. So if we want to think about the amount of dispersion, we can calculate a variance or a standard deviation. The simplest Excel function for calculating a variance is called VAR, short for variance, of course. And if we select the same range of data, we'll get a 5.8% or 5.81% variance over the course of the 5 years. And if we calculate a standard deviation, we can do that using a function called STDEV for standard deviation. And we get that the standard deviation over those 5 years is about 24.1%, which, of course, as I noted earlier, we could also just check is equal to the square root of the variance. So if we use the SQRT function in Excel for square root, we can just check that the standard deviation is indeed equal to the square root of the variance. So these measures tell us something about the amount of dispersion, and if we were willing to make further assumptions about what that distribution looked like, say, for example, that it was an approximately normal distribution, that might lead us to expect something about how likely it is that the S&P 500 would return in any given year more than, say, 1 or 2 or 3 standard deviations better than average. It would allow us to do some inference about things like how unusual is it for the S&P 500 to have gone down 37% in 2008. Of course, in order to rely on that kind of inference, not only would we have to make assumptions like S&P 500 returns are normally distributed, but we also would have to make some assumptions about how good a sample we think these 5 years are in terms of being informative about what the longer term distribution is. And of course, 2008 was an unusual year in some years. So let's look at what a longer time series might look like. So what this graph shows is a time series of the value of an investment in a variety of different asset classes over a long time series going back to 1925. So in particular, that S&P 500 that we just saw 5 years worth of data on the last slide shows up here as this kind of bluish line, which is the second highest of the wiggly lines. And to the degree that the graph is legible, you can see that $100 invested in that S&P 500 portfolio in 1925 would have grown by 2012 to be $319.287. That, of course, looks like a lot of money, although $100 could have bought you much more in 1925 than it could in 2012 due to inflation. So these are just returns in nominal dollars. And you can see things like the Great Depression here, so a big dip. Your portfolio would in fact have fallen well below the 1925 $100 valuation within a few years, but we see a massive recovery again up to over $319,000. And the other lines on this graph show what would have happened with an investment in other asset classes. So this red line, which goes up somewhat more steeply, represents an investment in smaller stocks, so U.S. companies outside the top 500 largest, and in contrast with the S&P 500 investment where $100 would have turned into $319K, an investment in small stocks has grown quite a bit faster, and by 2012 would have been worth over $3 million. The black line shows a world portfolio. So this is a portfolio of investment outside the U.S. or all around the world. In yellow, we see what would have happened if you had put your $100 into corporate bonds. So lent money to a broad portfolio of U.S. corporations. And then as those loans or as those bonds paid out coupons and face values, invested the proceeds in new corporate bonds. In green, we see treasury bills, which are a form of U.S. government debt, and then the very lowest is showing the CPI or the Consumer Price Index. So $100 worth of purchasing power, the basket of goods that you might have bought for $100 in 1925 would have cost you about 13 times as much by 2012. So one thing this graph shows us is just that we can trace out what the value of a portfolio invested in different assets would be, and the slope of each of these lines is, in a sense, informative about the average rate of return. So a steep increase like the red line that we see for small stocks suggests that the average rate of return is high over the time series. increase slightly less steep on the S&P 500. We calculated using 5 years of data on the last slide. We saw an average return of 3.1% per year over those 5 years, but actually over the longer time series, the S&P 500 has done quite a bit better than that. So just by looking at the steepness of the lines and comparing them, we can say something about what the average rate of return on these assets has been. But we can also look at this graph and look at the degree to which the returns have been wiggly and not just moved on the line. And the wiggliness of these returns is going to be related to the variance or standard deviation. So the variance or standard deviation are telling us something about how much the average year's return is far above or far below the arithmetic average. That's what variance and standard deviation are, and those are going to show up on the time series graph as wiggles. And if you try to eyeball it, you can probably see that the red line, the small cap stocks, looks kind of pretty wiggly. That's a highly volatile investment, and so you can see things like from 2007 to 2009, your investment in small cap stocks declined by 67%, whereas over the same period of time, the S&P 500 only declined by 51%. So that's what historical performance looks like. And roughly speaking, you could think about in historical data, average returns as being about the slope or the smooth slope, and variance and standard deviation being measures of the wiggliness. We could see something similar by looking at histograms. So these are basically distribution charts that show for each year, going back over the same time series, what the rate of return on 1 month treasury bills at the top has been, down through what it's been in small stocks at the bottom. And you can see that the distribution of returns in small stocks has been much, much wider. So the good years have been much better and much more frequent. The bad years have been much worse and much more frequent. In contrast, an investment in, say, 1 month treasury bills in green in the top basically never loses money. And I should say this horizontal line is the zero axis, but also never really gains very much. So we can't really see the averages very easily on here, but you can sort of get a sense that the green histogram has an average which is somewhat lower than the red histogram and the blue histogram, but also that the ones further down in the slide are more dispersed. And so this starts to give you the flavor of an idea for why we might think about a risk and return trade-off. That ones higher on the graph look sort of lower average return, but higher volatility, and the ones lower on the graph on this list here look to be higher volatility or higher historical risk, but also higher average returns historically. So in order to try to kind of formalize what we've seen on that graph, one thing that we can do is we can try to take our sort of standard assessment of expected returns being broken down into a risk-free rate plus a risk premium. So that's looking forward. Investors expect to earn the risk-free rate plus some risk premium. And we can just rearrange it algebraically and try to estimate how big the risk premium has been historically. That is to say, how much additional rate of return have investors earned above the risk-free rate. And we do that just by subtracting the risk-free rate from their expected return. Of course, we don't know what investors actually expected ex ante, but over the long time series, we may be able to make some assumption about kind of the average of what's happened historically, probably informs us in some way about what investors might have expected. So a typical thing to do would be for some asset class, say large US stocks like the S&P 500, we'll use historical realized returns, so the average rate of return over long time periods on equities, and associate that with the expected return. And then we could look at historical risk-free rates, say what have the average returns been on US government debt over a similar time series, and associate that with the risk-free rate, and then subtract one historical proxy from the other in order to try to estimate something about what we think the future risk premium in equities is likely to be. So if we do that, we only have to do the risk-free rate calculation once, at least assuming that we're looking at the same period of time or the same time series. And it turns out that over that period we've seen in the previous two slides, or the previous 3 slides, the average risk-free rate was about 3.8% per year, and the small stock portfolio earned an average return of about 17.4% per year. And so subtracting, we can say, well, ex post, investors earned a 13.6% average risk premium. That is to say, their average return was 13.6 percentage points above the 3.8% average risk-free rate. And to the degree that we think the past may be informative about the future, maybe we would want to conclude that investors in the future should expect to earn a 13.6% premium over whatever today's risk-free rate happens to be on their small stock investments. Now, of course, today's risk-free rate is not the historical 3.8%, but let's say it was 0.4%. If today's risk-free rate looking forward was 0.4%, we could use this risk premium assessment in order to guess something like small cap stock investors should expect to earn about a 13.6% plus 0.4% or 14% return on their investment going forward. And if we move down the asset classes listed, we can see that as the average returns, historical average returns decrease, mechanically the risk premia have to go up. And we, by definition, hit a zero risk premium when we talk about what we consider a risk-free investment. We could separately calculate volatility, and in this case, the measure we're using is the standard deviation of annual returns over the time series. And you can see that it turns out small cap stocks are indeed much more volatile than large cap stocks, which are more volatile than corporate bonds, more volatile than government bonds, although those don't necessarily order the way that the risk-return trade-off you might have in mind would suggest, and all more volatile than the returns on U.S. Treasury bills. Okay, so we start to see some evidence that maybe across at least these asset classes, there is some kind of risk and return trade-off. You earn a bigger risk premium on investments that have more volatility, or if we think about what the time series graph looked like, basically the wigglier lines have the steeper slopes and the smoother lines have the flatter slopes. So suppose we do this and we actually try to put this thing in a graph. So this graph tries to show the historical trade-off between portfolio and returns and volatility that I showed in the table on the previous slide. And so it takes a variety of portfolios and it graphs on the horizontal axis historical volatility, the standard deviation of returns, and on the vertical axis, historical average returns. This is the same data that we saw on the previous slide. Small stocks are high volatility, high return. There's a couple other asset classes that weren't there. So here's mid-cap stocks. Here's the S&P 500 or large-cap U.S. stocks, corporate bonds, and treasury bills. And not only is the relationship between these upward sloping, but it's sort of impressively linear looking. It looks like if you have sort of twice the volatility, maybe you have something approaching twice the historical risk premium. Okay, so we start to see some evidence of a trade-off in historical data between portfolio returns and portfolio volatility. And now you might think, well, what's going to happen if we try to draw more or less the same graph and we think about putting not these big portfolios, but putting individual stocks on here. So let's put Tesla and let's put Apple. Apple is lower volatility and Tesla is higher volatility. Let's try to put individual stocks on here and let's see if we kind of get the same, maybe not perfectly linear, but upward sloping relationship. And so we can do that in the data. And the answer is it doesn't really work. Okay, it doesn't really work. So what we've done on this slide is we've added on the same set of axes just the 500 S&P 500 stocks. And so with the triangles, we've got the 50 biggest. With the diamonds, we've got number 51 through 400. And with the circles, we've got numbers 401 through 500. And if you just look where most, for example, of the 50 largest stocks are clustered, not because the story doesn't hold for the others, but just because it's easier to sort of focus on a smaller set, you can see that they're kind of clustered here. There's not really a clear upward sloping linear relationship between them. It's not really obvious. I mean, looks like maybe there's kind of some upward slope to the cloud. But one of the things that's particularly interesting about this is not just the lack of a clear linear upward sloping relationship, but also the fact that every one of these stocks, with a very few exceptions, actually lies to the right of the line. Okay, to the right of that line that we saw for portfolios. So what does that mean? It means that for a given level of returns, let's only consider, say, investments that have earned 15% over the historical period that we're analyzing. All of the individual stocks that have earned 15% have higher volatility than the portfolio of mid-cap stocks, which on average has earned a 15% rate of return. So once we move to individual stocks, the relationship goes out the window, and the individual stocks, by and large, look worse on a risk-return trade-off than the large portfolios do. They're higher volatility for a given level of return. So what could be going on? Well, it turns out that stocks, individual stocks, are riskier than portfolios, and the reason that they're riskier is due to the power of diversification. So when you build a portfolio, as we did on the last slide, you wind up including some stocks that go up when other stocks of similar risk go down. And so the fluctuations up in one and the fluctuations down in another have an ability to cancel each other out, such that the returns on the portfolio as a whole are typically smoother than the returns on any individual portfolio. And so when we take, let's say, large cap stocks, the 500 largest in the country, which are all shown here, the diversification pushes the risk of the portfolio as a whole to the left. And so this whole cloud of the 500 largest US stocks winds up forming a portfolio, which is that S&P 500 dot to the left, has the same average return as the average of all of the dots, but has lower risk and appears to the left. So diversification has to do with the fact that different components of a portfolio may move in opposite directions. And so the risk of one has the ability to offset the risk of the other. So how much diversification do you get in a portfolio? Well, it's going to be a function of the degree to which the different things in the portfolio tend to move in the same direction as each other. And one way that we can measure that is by taking a pair of assets and asking how correlated their returns are. So stocks that have highly correlated returns are going to both go up at the same time or both go down at the same time. Stocks that have less correlated returns may have one up when the other's flat, or one down when the other's flat, one up when the other's flat, one down while the other's flat. And stocks that have negatively correlated returns are going to tend to move in opposite directions. And so it's that negative correlation that's going to generate the highest degree of diversification in the portfolio. How correlated do two stocks wind up being? Well, it tends to have to do with what industries they're in, what their size is, what geographies they operate in, and what other kinds of business relationships they have. So just to take two examples, if we think about Ford, the auto manufacturer, and Apple, I would say computer manufacturer, although now really they make much more of their profits for mobile devices, Ford and Apple have a positive correlation. They're at the right, but they have a positive correlation of perhaps 0.15. So a 15% or 0.15 positive correlation, consistent with the fact that when the economy is doing well, people buy both new phones and new cars. When the economy is doing badly, maybe they don't buy either of those things or replace them. But, they don't move in any kind of lockstep. They just tend to move in the same direction at the same time. If we contrast instead Ford, the automotive manufacturer, with Goodyear, the tire manufacturer, they have a correlation which is higher, let's say about 0.6. Or 60%. So they have a higher positive correlation. Why? Well, because when people buy new cars, they need to buy new tires for their cars, but also because good news for Ford is not just that the economy is doing well. It might be things like gas prices or oil prices have fallen, and so people drive their cars more than they would have otherwise. People who drive their cars more both need new cars faster, which is good for Ford, but also need to replace their tires more often, which is good for Goodyear. So in general, correlation coefficients are always, not in general, in fact, correlation coefficients always lie between -1 and +1. That's the way the statistical concept is defined and normalized. And so assets that move perfectly together, they always move up together or down together and have a linear relationship, we call perfectly positively correlated. They're going to have a correlation coefficient of +1, and they have no diversification benefit to each other in a portfolio. In contrast, assets that always move in exactly opposite directions are going to be perfectly negatively correlated with a correlation coefficient of -1, and they're going to provide the maximum diversification benefit. In the extreme, we call a portfolio that's perfectly diversified, perfectly hedged. And so when one part of the portfolio goes up and the other part goes down, and those things exactly offset, you can build a perfectly hedged portfolio. So that's going to be the end of this discussion, but it's going to tee up an introduction to more of the details of how the CAPM or capital asset pricing model works. The intuition behind the CAPM is going to relate to the fact that the risk of an individual stock, not of a portfolio, but the risk of an individual stock is associated with the degree to which it has risk that you cannot diversify away. Because if you can hedge risk in a given investment, if you can put other things in your portfolio to diversify away the risk of an asset, in a sense, it shouldn't matter and doesn't matter whether that investment has very high volatility, very high variance or standard deviation, because what you should care about is not risk in a given investment, but risk in your portfolio as a whole. And so it's going to turn out that the CAPM is going to give us a set of mathematical tools for trying to draw a risk and return trade-off that exists for individual stock in a way much more compelling than what this graph suggests we would get if we tried to analyze that trade-off for individual stocks just using variance or standard deviation.